house price fall of up to 10%, potentially Australia's largest property correction in 40 years.
We're going to have the biggest property price correction in 40 years. The capital gains negative gearing, very poorly timed. We've got a housing market that is at a cyclical peak. The RBA's just hiked rates 3 times, got the highest cash rate in 15 years, equal highest at the peak last year, and financial markets think it's going to go higher again. We're going to get another rate hike. We're already in a downswing, sentiment's terrible, and now the government's basically put more downward momentum on that with these changes. A lot of people view this budget as a tax grab because they increase taxes. You need to earn 1.9 times the median full-time to now pay the top rate. The system is built to tax you more every single year, even when you're going backwards. Someone who still wants to invest, investor borrowing capacity has been hit because the negative gearing rule. Investor borrowing capacity for negative gearing has gone down by up to 30%. The bottom 40% could hold up pretty well. It'll be the sort of higher end that'll probably get spanked more. This is bleeding money. I'm getting out at any price.
You're listening to the Follio Property Podcast. I'm Reece, Beddall, and I'm here each week with my co-host Lachlan Delahunty, most requested guest back in the building. I thought he might be too big time for us now, Lachlan, after his tour of the big podcasters over the last couple of weeks. But Leith Van Onselen, welcome back to the Follio Property Podcast.
Thanks, Phil. Thanks for having me back. I'm always happy to come back here, mate. I had such a great time last time. We had a good chat, so let's do it again.
You call it how it is, so that's what we like, and I think that's what the listeners want to hear.
Listeners do want to hear that. I was just telling you off air, feedback was they want more. They were disappointed we only had half an hour. So we will go longer today. We won't cut all the good bits out, but hopefully we can get you back for round 3. But hey guys, quick thing to share. If you're serious about investing in Australian property right now, you need to see what we put together. It's called the National Investment Report, and it's our brand new monthly deep dive into exactly where the market is moving, what the data is saying, and what the smart investors are looking at right now. You can get the first access completely free. Just scan the QR code on the screen right now or click in the link below to fill out the form. First things first, Leith, we're a couple of weeks post-budget now. What's your thoughts from the budget, not just property related, but as a whole?
The backlash, which they could end up undoing, is I actually think the capital gains negative gearing changes to property are very poorly timed, right? So whether you agree with them or not, in principle, now's probably not the time to do them, right? So we've got a housing market that is at a cyclical peak, not everywhere, but nationally. If you just talk averages, it's at a cyclical peak. The RBA's just hiked rates 3 times. We've got the highest cash rate in 15 years, equal highest to the peak last year, and financial markets think it's going to go higher again. So we're going to get another rate hike. We're already in a downswing. Sentiment's terrible. We've got the war in the Middle East. We've got rising unemployment now. We're probably already looking at a fairly decent property price correction nationally. And now the government's basically put more downward momentum on that with these changes. So it's pretty poorly timed. If they'd done it during the start of an upswing, it probably would have landed a bit better, right? You would have actually taken some heat out of the market, but you don't really need to exacerbate the downside. So it's kind of been a pro-cyclical tax move at, I think, the wrong time. And what I think could happen is that we could end up following New Zealand. So New Zealand did a similar thing in Jacinda Ardern. They first restricted negative gearing in 2019, then they tightened those rules, I think it was in 2022. New Zealand's had basically a property price crash. And now the national government came in, the new government, and they've totally undone all their rules. So they had an effective capital gains tax, which is called the bright line test in New Zealand. So basically what it meant is you only avoid paying capital gains tax if you held the property for 10 years. So that used to be 2 years, then it went to 5 and then 10 under Jacinda Ardern. And then they did negative gearing like we have, but then they did it even more tightly, so you can't even claim mortgage interest against your property. So they tightened it and made it ridiculous, made no sense. They've had a property price crash. Now the new government's come in, gotten rid of negative gearing entirely, brought back the old negative gearing rules. And then also they've put the bright line test, so it's effectively their capital gains tax down to 2 years. So if you hold your property for 2 years or more, you pay 0 capital gains tax. So it's incredibly generous. And there's no stamp duty in New Zealand.
So 0 capital gains.
0 if you hold it for 2 years.
That's pretty encouraging, and it stops the flippers within the short period.
Yeah.
You bring on accommodation and you get rewarded handsomely for contributing to the contract.
It is a property investor's dream over there. You pay no stamp duty. You got basically no capital gains tax if you hold it for 2 years, and you can negatively gear now. But so Jacinda Ardern made that a lot. Basically, if you had to hold it for 10 years not to pay capital gains tax under the bright line test, that was it's been changed a lot. But at its worst, that's what it was. And then obviously made a punitive negative gearing, complete removal, more vicious than what we've done. And
So you see that playing out here in Australia?
potentially. So,
how long
I mean,
would it take to really come into effect?
well, yeah, I mean, if the government keeps getting tomatoes thrown at it, keeps sinking in the polls, if we have a much bigger property price correction, which I think we will, I think we're going to have the biggest property price correction in 40 years.
Which is only 15%.
Well, mate, it's not even. So that's a great headline. But, I said this in Carl Stefano, we're going to have the biggest property price, like this, right? And then they use that as their thing. But then I qualified it because the biggest in 40 years, according to Cotality, is only 8.2%.
Yeah, which is...
nationally, which is not that much. But I think we're going to beat that.
Going off an 80% upside and you had an 8% correction, reality is...
Yeah, so that's it. So it's not saying that much. Like to beat, to get 40%, the biggest in 40 years doesn't actually mean a hell of a lot.
I saw an article in the Perth newspaper, and they said, Trent actually said this. They said the average days has doubled in Perth. Like the market's cooling down, but it's gone from 7 to 14, which is tight.
Yeah.
Yeah. Oh, look, Perth's a different market, mate. Like it is, and even
you were quoted, and this is the interesting part. So I woke up and got sent an article which was house prices are going to fall by up to 15%, and there's a picture of Perth.
Yep.
And then what idiot is calling this with the tightest whole market in Australia? And I'm like,
I was misquoted.
And then I went in there, and it's got it's your name, it's your article, but you're referring to predominantly nationally Australia.
Yeah, I don't think it said 15%, but I don't think it said biggest in 40 years, and it said it could be up to no. What I said, I think I quoted New Zealand and Canada saying that they've gone more than 15%, and that's it's a risk. Australia could go down that road, something like that.
Yeah, but they've dragged Perth into that, and probably Adelaide, and realistically, and that's where I get frustrated with some of these journalists. They'll take a little bit of what you said, and then they'll try to insert into a market where I believe has absolutely zero relevance, because you've got the tightest market in the country on one extreme, and then you've got Melbourne and Sydney on another extreme, and you've got Adelaide and Brisbane probably somewhere in between. Yeah,
well, that was hilarious because that article, I got sent that. This is how the media works often, right? So I've got a friend, Catherine Cashmore, I do a podcast with her. She's like a buyer's agent.
She's a doomsdayer talking the cycles.
Yeah, but she's a friend of mine, and she goes, oh my God, look at this. And then she sent me the text, and then she sent me another one, and I think it went to the Daily Mail or something, and then it went to WA Today or one of those ones, and then it just did this whole thing around the internet. And I was just laughing, going, oh, this is hilarious. And they had our photos. And all it's just the way it works, mate. Yeah. Like, it's clickbaity stuff. But the thing about it is if we got, say, a 10% decline nationally, right? Biggest in 40 years, great headline. It's a good one if you want to get the clickbait, right? Yeah, it works beautifully. Biggest in 40 years. You do that sort of thing. But, say it's 10% nationally. But it's a bit like the ASX 200, right? If it dumps 10%, you go, oh, wow. There'll be some within that, some capital cities. There'll be some submarkets within those capital cities that are a lot worse. There'll be other ones that are better. It's an average. And let's be honest, the national aggregate is driven very heavily by Sydney and Melbourne. So Perth's got a pretty small impact on it.
Probably 10%.
Yeah. So a 10% national doesn't mean 10% everywhere. Some markets could go down bugger all. They might even, hold the line, whatever, and other ones will go bad. So, for example, I used this in a recent interview when quoted on this. I said, look, the Mornington Peninsula of Melbourne, well, it used to be Victoria, but now it's sort of part of Melbourne. So that's sort of, about an hour or so away. Sorrento.
It's a lifestyle market.
Yeah, that's it. So some of the values there have tanked 50%.
Yep.
Right, and part of that is because they basically doubled in value during COVID. So we had the Dan Andrews lockdowns. We got smashed down here. 9 months of lockdown were basically, it was horrible. But a lot of people could escape to those areas. It was just outside the lockdown zone. And a lot of people bought up in those areas. The prices pretty much doubled. They rocketed. They got completely absurd. And then obviously we've gone through a downswing. The Victorian government bought in, smashed property investors with huge land taxes. A lot of people there are holiday homeowners. They rent the homes out. Now the ATO's whacked them with stricter rules on how many days a year you've got to let it out. So basically, they've been whacked with massive land taxes, and some of the properties there were paying tens of thousands of dollars in land tax now. So people are just going, look, this is bleeding money. I'm getting out at any price because I just can't afford to carry it. So that is...
And now there's no buyer for that product because they can't get the negative gearing benefit. So you've got, and I've seen it. We've seen live examples where there has been, upwards of 50% declines.
So there's always markets like that, especially, so that's a specific case, right? It doubled in value and then tax changes completely wrecked the economics of it. It was a perfect storm going up because of the lockdowns and everything.
And the perfect storm
going down, right? So when you say 10% nationally, there's examples like that at the extreme end, and there's other ones where, if you're in the below the 5% deposit scheme caps, I think those markets are going to hold up pretty well, right? Because if you're an investor now who's, say someone who still wants to invest, investor borrowing capacity has been hit because the negative gearing rules. So basically, from the reports from banks and also from some people I know who work in this space, they've said that investor borrowing capacity for negative gearing has gone down by up to 30%. So it depends where you are on the income scale, because banks now consider that you've got less after-tax cash flow because you don't get the negative gearing benefits. Yeah. So that could mean that could target investors more to the lower end properties, ones below the 5% deposit scheme caps, because they can't borrow as much. So people who want to invest might target those homes, and then you've got the first home buyers targeting those homes because they're still below the 5%. Yeah. So the lower price properties below those caps, the sort of bottom, 40%, could hold up pretty well. It'll be the sort of higher end that'll probably get spanked more.
And that's what we're seeing both in Sydney and Melbourne, the higher end really come off. But
they're always more volatile though.
Yeah, without a doubt. But if you look back in time, and we track property markets specifically, more so than we do politics or economics, but property markets around Australia, there's never been a moment in time where all markets have come off at the same time. It's always counter-secular. So if you look at GFC, obviously Melbourne and Sydney for a small period got whacked, but then Perth, saw up to 100% growth the years following that, and reverse that, 2017, 18, APRA come into play, absolutely killed markets like Perth, Adelaide got a hit, but then others rebounded really, really quickly. So and I know it's not your conversations that you're going out saying nationally that markets are going to fall, but it's interesting because that does hit sentiment. And, your voice, Catherine, who you referred to, talks about the 18-year cycle. We spoke a little bit about that in the last podcast. It's interesting that we speak a lot that sentiment can drive markets as much as anything. And at the moment, there is low sentiment. But when you drag all markets in to that news story, it can be quite detrimental.
Yeah, 100%. So look, I'm obviously a macro guy, right? So I'm always looking at the big picture.
Yep.
And part of that's data driven, right? Because, if you're looking at the Cotality Daily Index or whatever, you get 5 markets only. And so you're looking at the whole of Melbourne, the whole of Sydney, the whole of whatever. I don't look at the little sub-markets within markets. Obviously, if you're looking for investment opportunities, you got to, all real estate ultimately is local, right? So if you're looking to buy something, you got to look at the local market within that market. And they're all different. Again, to use that ASX 200 analogy, some companies, even in bull markets, are doing terribly, and some are doing great. Obviously, a bull market, more are going up than down. And in a bear market, some are doing great and most are not doing well. So it's similar to property. And this negative sentiment stuff, if you're looking to invest, well, it actually could be to your advantage, right? Because you can more likely get a better deal when you're buying. So if you're someone who's pretty savvy and doesn't want to go with the herd, and you can target a market that will buck the trend for whatever reason, go for it. But I don't do that sort of stuff. I'm looking at the big picture, partly because that's all the data you got. So you get your weekly auction clearance rates, for example. You get the whole of Melbourne, the whole of Sydney, whatever. That's not giving you the little micro, inner east is doing this versus the outer western suburbs, and you don't get that nuance when you look at it at the big picture level.
I was going to go back to your earlier point, actually, when you were talking, you were supportive of the changes, but then you also said you don't think they're going to go through. So,
no, I think they'll go through, but I think they'll ultimately get. I think there's a good chance. I'm not saying they will, but there's a good chance that we could go a couple of years down the track and they get reversed, a bit like what happened in the mid to late 80s.
Yep. Okay, interesting then. So let's go on the previous thought then. Why do you think this is potentially a good move for the property market with the CGT and the negative gearing changes?
So I take the I don't want to call it selfish, but it's I guess it sort of is selfish. So I've got 2 teenage kids, and I want them to be able to afford to get have a home that's affordable. So for me personally, I'm actually pretty happy that Melbourne, for example, has had pretty much no house price growth since 2017. Now, because I'm not an investor in Melbourne, I own my house, I own it outright now, but I'm living there regardless, right? So I don't really care if it goes up or down in value personally. But I do care about my children's ability to be able to get into a home and not have to mortgage themselves to the hilt. And also selfishly, so the selfish bit comes in, I know I'm going to have to help them in. For example, you could get a good freestanding house with a good block of land, whatever, for $1.5 million in Melbourne, in a good area, like one of the nice areas, versus $3 million. Well, that's better for me, right? I don't have to help them as much. So I'm personally, for me, if you want to make housing more affordable, the price has to come down. It's as simple as that, right? You don't make petrol more affordable by the price going up, and then allowing people to have easier access to credit to then buy that petrol. Ultimately, if you want the systemic cost of housing to come down, the price has to come down.
So, reading between the lines there, like these handbrakes that we've pulled, you think that is going to have a drastic impact on property prices from a macro level? I know.
Yeah. Well, I mean, certainly. I mean, it'll have a short-term decent impact, and then long-term it'll stop having. You won't have as bigger up cycles now, because you won't have that investor demand as hot as it was before. So yeah, I think if you fast forward, say 20 years, the prices will be, a decent amount lower than they were before. But at the same time, there's a whole bunch of other factors that are feeding.
Do you think this could be a decade of negative house prices? Is that what you're saying?
Maybe not negative, but we could have I think the super cycle's over. So we've had pretty much a 25-year super cycle in values where they've just continued to rise relative incomes and stuff. I think we could have a flattish patch for years, nationally. I'm talking about
even with the migration forecast that's predicted.
They're
letting 500,000 people in the country a year. And
that's more a rental story. So when you talk about property prices, if I had to rank the inputs like migration's impact to house prices, I'd say it's probably might be 20%, maybe 15%. If you had to say all the different factors that drive up house prices, I'd probably give migration weighting of 15 or 20% or something.
And credit 50%.
Credit availability, government policies, 5% deposit schemes and stuff, tax policies and all this other stuff that goes into it.
Let's work through that. Let's weight it out. So you'd say 10% on migration. Yep. What would you say for credit availability?
That'd at least be 50%.
Yeah.
And then
tax policy.
Yeah, tax policy, and then I've never even thought about that'd probably be at least 20%. I'm probably going to end up saying, that'd be 20, and then it won't end up adding to 100. So I haven't actually thought about it. I just put it on a spreadsheet. So I'm already at 90%. Hang on. And then you got government policies like the 5% deposit schemes. You got bank of mum and dad. And you got all this other stuff. But there's a whole bunch of factors that feed into prices.
But you're saying credit availability is far more important than migration.
100%. Yeah, credit availability and interest and cost of credit and stuff like that is way more important. And we basically have constricted credit availability now and cost of credit, because obviously we've had rate hikes, and with rate hikes you get lower borrowing capacity, and then now we've had borrowing capacity directly get cut because of the negative gearing and capital gains tax changes, like on the investor side. So up to 30% less borrowing capacity there. This stuff all weighs down on house prices, and there's a fantastic chart Shane Oliver's done, where he basically has done the median house price in Australia, and he's done capacity to pay based on all these sorts of factors. And traditionally, they've kind of gone up, although prices have decoupled a bit, but they've kind of gone up together, right? So prices rise at borrowing capacity. In the last 5 years, it's gotten a massive divergence. So prices have kept going up, but capacity's actually fallen as we've had these rate hikes, etc. Ultimately, that gap's got to narrow. And it's either going to narrow by interest rates tanking, and then that increases your borrowing capacity up towards the prices, or prices falling. I think we're going to get the latter, because obviously rates aren't coming down yet. I think there's a good chance they might next year. But
agreed.
And at the same time, we're having this tightening in credit availability because of like the negative gearing and capital gains tax changes, which is reducing, which banks have already cut investors' borrowing capacity. So we've got that, and also we've got the other dark horse out there, rising unemployment. So unemployment's now drifting higher. It's still not, 4.5%. You don't go.
If that goes up, the RBA hand would be potentially to reduce
cut rates.
Rates, right? So
100%. So I actually think next year we'll probably get rate cuts, because
that's a huge call, because the futures wouldn't put that in, and if we see a rate cutting environment, that would then argue a price uplift.
100%. So, but that sometime next year, I wouldn't be surprised if we get rate cuts, because I think the RBA is kind of, and their hand's been forced, they're kind of mirroring what happened during the GFC. So if you remember that, we had the US subprime crisis in 2007. So that was kind of late 2007. And then the RBA hiked rates by 1% after that over the following year. And then the full-blown GFC, when Bear Stearns and Lehman Brothers collapsed in September 2008, we had the full-blown global financial crisis. So it started off in America. That was about a year ahead. And the RBA hiked by 1%. We had pretty high interest rates then. And then they were forced to cut by 4% after when the GFC hit. Now, I don't think they'll cut by 4%. They're obviously not going to cut by 4%. We're not starting from as high a base.
We saw that recently play out with COVID.
Yeah.
You know, it could be catastrophic for the markets. So,
well, for the economy in general, I think a good chance Australia will have some sort of recession. So we're already, the latest, the March quarter national accounts, we had 0.3% growth for the economy, which is bad growth, but it's growth. But per capita, we're back to, we've now got another negative quarter of per capita growth, only down 0.1%, but we've had 10 out of the last 15 quarters have been negative in per capita. I think we're going to have likely another per capita recession. I think the next quarter is going to be negative as well. And then I wouldn't be surprised if we have a full-blown recession because the RBA is tightening the energy shock from the Middle East, which, at some point we're probably likely to get some sort of fuel rationing. It hasn't hit us yet because I think we've been burning through our storages and we've managed to, sort of muddle our way through. But, there are, a lot of farmers haven't planted their crops for this year because they're worried about availability of diesel. We're going to get some sort of, impact on the economy there, which will hurt growth, obviously. And I think we're going to get rising unemployment as well. So in addition to the weakening economy, we've also got the government now is trying to cut back expenditure on the NDIS and that sort of thing. That's been one of the biggest job drivers we've had in the last 5 years. So most of Australia's job growth, at least since the start of 2023, has been in this non-market sector. So that's the government-funded sector, whether it's bureaucrats or it's, the healthcare sector, et cetera. So the jobs that are affected, they're not necessarily public servants, but they're funded by government. And a lot of that has been in the NDIS. That's been the main job driver. Now the government's trying to reduce expenditure on the NDIS from double-digit growth annually to 2%, which means that you're going to get less growth in jobs in the NDIS if they do cut expenditure, which means going to have that tailwind is going to disappear.
Unemployment rises.
Yep. And at the same time, we've got this AI issue that's rolling out globally now where a lot of HR managers, et cetera. So that Mercer, it might have been Mercer, I might have misquoted that, but there was a major HR survey that was done about a month or so ago. And basically 100% of the HR managers who were interviewed expected job losses because of AI. CBA's boss, Matt Coman's come out recently said there's going to be job losses because of AI. So that's going to be another headwind for employment. So I think, going into next year, we'll have rising unemployment. It already is rising, but rising more than the RBA expects. A weaker economy than they thought, a bigger housing downturn than they thought. And I think the RBA is going to be forced to cut next year.
And then run that out because there's sort of conflicting information in the sense that if, the government has got it wrong and they were to reverse policy around negative gearing and capital gains in the next couple of years, or the new government comes in 2028 and reverses it, which, seems to be the theme of how they're going to run up to the next election, then you may have falling interest rates, calling that as early as next year. We know migration is going to be extremely strong for the next couple of years while the Labor government's still in, which I know it's a passion of yours.
Yep.
But those three factors, if all would come into fruition, that's a perfect storm for a rising property market.
Yeah. Well, I mean, that's it.
That would be that would call for a boom in housing prices.
Yeah. Well, I mean, certainly a rebound. Yeah. I mean, if all those things happen, that could certainly happen. But I think before that, we're probably going to get a decent downturn. But I mean, that's the thing, right? You guys are property investors, so you always got to be cognizant of where the opportunities are, right? So I've got a few contacts, for example, in the Brisbane housing market, and I speak to them, like real estate agents, et cetera. I know that market well, and the change there has been quite astronomical in the last month or so, especially those properties that are priced above $1 million, which is above their 5% cap. So those markets have been getting hit pretty hard, and there's been a massive change in sentiment there, according to the real estate agents and everyone I speak to.
Yeah, well, they're on the ground, boots on the ground, right?
Yeah, that's it. But obviously, the people I speak to, they don't work in the outer areas that have got those properties below $1 million, which get the 5% deposit scheme, and those markets, at least going by the data, are going a lot stronger. But certainly there has been a change in sentiment up there, and I've if you look at the Cotality Daily Index, Brisbane's still growing, but it's coming off really hard. I get their weekly market indicators report, which is basically shows you their number of listings. And 3 months ago, Brisbane's new listings were well below last year, and its total listings were well below last year. And then over a period of three months, maybe 4 months, every single week, it started to shift. And then now it's gone the other way, and now there's far more new listings than there were at the same time last year, and far more total listings. So I think Brisbane's turned. Perth's still got a shortage, right? But the shortage has narrowed versus what it was 4 months ago. So it's definitely cooling, but it's not. It's still strong.
Significantly undersupplied.
Mate, Perth's a unicorn. And part of that's because, I live over here in Melbourne, and when you live in Melbourne and you live in let's be honest, what's become a bit of a failed state, right? Victoria, your perceptions, no matter how you look at the data, you are going to be clouded by your environment. And Melbourne's been, especially with regards to property, it has been a dead market for years. And quick example, 3 weeks ago, I went to an auction in my street. I don't usually go to auctions because I'm not looking to buy, right? I can't be bothered. I'm too busy. There was one about 10 doors up. And so it's one of these 1940s double-story brick houses, really nice, big block. One of these houses that I always thought, I'd love to go and see what that looks like inside, because it was one of those sort of character houses. It's got one of those houses that has a name on it. The people put the names. So, went in there, mate, this auction there was one guy who gave a bid for 1.6 mil, which, to give you 2017, that house would have sold for 2 million. No doubt about it. Had one guy gave a lowball bid.
So 20% discount.
Oh, mate, huge. And there was just zero interest. Crickets, the guy goes, no. And then the vendor bid for 1.7. And the person who was selling it was an investor who had owned it for like 20 years, right? So they would have still made decent money. And the auctioneer was basically begging to sell it. It was ridiculous. Oh, the vendor will accept any reasonable offer. The vendor just wants it gone. Basically, that's what he was saying. And there was like 5 neighbours, and this one guy who just shrugged his shoulders and walked off. And it was, I was actually shocked, because this house, pre-COVID would have gone for minimum 2 million, and possibly a fair bit more than that. And that's the sentiment I'm living in, because that's what's happening around me.
It's a scary thought that probably traded for 1.5 on your predictions. Could be trading for 1.3 in the next 12 months if it was to come off 15%.
Yeah. Well, I mean, that's the thing. So I think last time I was on with you guys, I said, Melbourne's probably a safe haven, right? I think I said something like that, because you'd think logically, right? Melbourne has had basically bugger all growth for...
Well, every other market's done 80 to 100%. It's done nothing.
So if you go by, PropTrack's data since the start of the pandemic, it says Melbourne's gone up, I think, 19%. But before that, it was higher than that. So whereas Sydney's gone up about 40-something%, Brisbane, Perth, Adelaide, more than doubled. And so Melbourne's just lagged everywhere else. So you think, based on that, well, Melbourne hasn't had the upswing, and it's by far the cheapest market out of the major capitals now. So therefore, it'd be protected on the downside, right? So I'm sort of a believer in some kind of mean reversion somehow. It doesn't mean the prices can't be trending up, but I just think if a market overshoots too much, it usually comes back. And that's been the story of Perth and Brisbane and all these other places. But Melbourne, I've got a series I run going back to the early 1970s. I do a relative house price valuation. So I do each major capital versus the weighted average of the other capitals.
Yep.
And Brisbane's right at the top. So it's almost at its most overvalued in 50 years. So there was one time, I think 2004, it was about the same. And if you actually look at it, it's like a wave. So it kind of gives you a perfect time to buy was...
Can we share that on the podcast as listeners are watching this? They can look at it.
Yeah, I'll send to you. So basically, it's kind of crude. So I've just got basically house price data from this series called Abelson and Chung, which is like some guy did his PhD, did median house prices for all the majors going back to 1970.
Yep.
And then I interspliced it from about 2005-ish with Domain's house price data. So it's just detached houses.
Yep.
And I've just been updating it for 10 years. And Melbourne is basically at the opposite of that. So it's almost the cheapest it's been relative to the other capitals in 50 years. So you think based on that, well, it'd be fairly well protected on the downside because it's based on fundamentals. Nah, it's getting smacked again. So it just goes to show,
So with that in mind and that graph, so you think Brisbane currently is the most overvalued market in Australia?
Based on that chart. So Perth's a little bit above its average over the past. So it's got I've done a line with the average and it swings up and down.
Yep.
But Perth started off from such a low base because you had that sort of 6-year property correction
9
where
years,
9 years, where Perth just became so cheap after falling by nearly 20% nominal. So you were starting off in a really low base. Brisbane now is at the top of that cycle. Adelaide's over-ish valued, but nothing like Perth. Like Brisbane just looks like it's an absolute overvalued bubble based if you go off these charts.
And you think it's, by the sounds of it, it's about to burst.
Or at least I mean, bursting in Brisbane could mean has, I don't know, single-digit price declines, but then has no growth for a long time, which is basically what happened last time. So Brisbane, after its last upswing, I'm trying to remember what it was, might have been early 2010s. It did nothing for at least a decade leading up to COVID. And then it became incredibly cheap, and then it upswung. So I think, based on this on this chart, and I actually did look to buy in Perth during COVID. I wish I had. I didn't want to extend myself at the time, but because of the work situation. But at that time, these charts were saying Perth's never been this cheap.
Yep.
And it still looks like it's still got more upside though.
Where does Sydney sit?
No, Sydney's sort of weird because Sydney's so expensive. It kind of, like Sydney, you don't get as good a reads. I think
I've been calling the top of the Sydney market for the last 3 or 4 years. And
so Sydney's, according to this, is just moderately overvalued compared to what it's been in the last 50 years. So it's just if you saw it, it hasn't given a great signal.
Yep. But what's your personal view outside of that on Sydney at the moment? Do you think it's going to will it be the hardest hit market in Australia?
It could be because it's the most expensive market, and it's also has been, it'll be more heavily impacted by these borrowing limits and stuff, just because you have to borrow so much money to buy in Sydney. So therefore, when
and the incomes haven't gone up at the same level as house prices.
And so the price to income ratio is massive. So what it means is when you get rising interest rates or falling interest rates, Sydney is disproportionately impacted. And if you have changes in borrowing capacity, Sydney will be disproportionately impacted. I'm pretty bearish on Sydney. I'm bearish on Brisbane as well, just because it just screams overvaluation. Some of the properties there, if you do the analysis on it, and I looked at one in a sort of, if you look at that inner south area, which is the area I know pretty well, if you bought a house, for example, 1.5 million, you'd be lucky to rent that out for $750 a week if you're lucky.
So an investor now post-budget can't buy that.
Oh, mate, no way. And even to buy that with the negative gearing, you're looking at a net yield probably once you pay all your stuff. Because, if you buy an older house that it always needs work, you got to pay your agent's fees and all that sort of stuff. You'd be lucky to be getting under 2% yield. And to me, that doesn't make sense.
Puts a lot of pressure on capital growth at that.
Yeah, it does. And when you've just had prices double in just over 5 years, it's like, well, based on the charts I've got, you go, well, why would you buy then? Hoping that it's already the most overvalued relative to the other capitals in 50 years, pretty much. Like, I think it's the second most. Why would you then buy with a less than 2% net yield, thinking that it's going to suddenly go up even more? Like, to me, that just doesn't make sense. Like, you're better off just looking at other markets.
What do you think's different this time in terms of a correction? So, I mean, you were on a podcast, a couple of months ago and said, you've got it wrong.
Melbourne, yeah, 100%.
You've got it wrong at times. I think in 2018,
Mate, I got it wrong heaps of times. It just, mate, there's no crystal ball in this stuff, right? So you can, So anyone listening to this, don't go, I'm going to buy on this guy's advice, I'm going to sell on this guy. Like, seriously, do your own due diligence. I can only I can give you the macro story of what I'm seeing, the data, but yeah, like I'm that guy, right? I can look at Brisbane and go, this just, based on the data, it just looks insanely overvalued. And it might buck the trend for another, because the vibe, I've got to say, the vibe up there is different though. So I go to the Gold Coast. I know I'm always on holiday, right? So you can't always take a holiday mood, you got to take it with a grain of salt. But every time I go there, I went there late last year. I was there a few weeks ago, about a month ago. It is a different vibe up there. Just in general, there's a lot of building going on. It's a lot more positive.
But that's late cycle. Anything that's going through a boom period, typically, and hasn't corrected yet, the sentiment's going to be high because everyone's got equity, everyone's got job security. There's a lot of work. Yep. And no one typically sees that correction coming.
No, that's right. But for me to sit here in crappy, depressed Melbourne, right, and then going, that's overvalued, therefore it's going to, correct based on the data, which is what the data tells you. It doesn't account for the fact that I'm not living there, and I'm not seeing how the economy's tracking, and all the opportunities and all that sort of stuff because you're not there.
Yeah.
So there's only so much you can.
You're looking at the numbers, right?
Yeah, that's it. Yeah, I'm
Take
looking at the
a
numbers. So anyone listening to me, don't go, oh, I'm going to take lease advice on. Like, you got to do your own diligence, right? I'd say that for anything. Like, never take anybody's, advice as gospel. But all I'm saying is,
You're looking at the macro, essentially.
that's it. Yeah, that's it. And I'm not in the market to buy either, right? So I'm not going in, looking at individual areas and opportunities and all that sort of stuff. I'm just looking at the total picture, and just based on the macro that we've got now, we've got rising interest rates.
Yeah. Is this different? So the point I was probably trying to get across was when 2018, when you probably last thought there was a correction, is this the same environment right now as what it was 2018, or have things changed to?
Because that was pretty significant. APRA come in, for those that are listening, what Reece is referring to in 2017, APRA come out and pretty much removed investors from getting interest rate
and
in their
Banking
loans.
Royal Commission.
Yeah, and Banking Royal Commission. So handbrakes, that's when we got these buffers in terms of credit buffers.
Yep.
They put the handbrake on investing. So property investing, even with capital gains changes and the negative gearing, there's still going to be property investment. 2017, they said we don't want any more residential property investment to really curb the Sydney market. It didn't play out as bad as probably what we predicted, but you think the current environment's different, or
I think it's worse. So that was kind of a single event driven. Actually no, it was. I'm probably not being fair. So we had the Banking Royal Commission. So there was all that. We didn't know, so that was in the news every day and whatever. Nothing ended up really coming from it. We had APRA tightening the screws on investors. But we also had, so back in that time, Bill Shorten was expected to win the election, right? So that was leading to the 2019 election. And he was going to do what they've done, right? So people expected that. When they lost the election, mate, the market just went like that, totally reversed. Yep. And I know that because one of my mates, and he's prominent guy. I'm not going to call him out because I haven't got his permission, but he actually purchased a house in Sydney during that period and got a great price on it before he bought it, and then it just rocketed because he literally, it was about a week before the election, and it was during that period where sentiment was incredibly low, buyers were thinner on the ground. Yeah, that's it. But then the election didn't. It's obviously ScoMo won. The property tax changes didn't happen. The Banking Royal Commission just went into the background. Market boomed, right? And during that period, that was when we had the biggest correction in 40 years. That was the 8.2% according to Cotality nationally.
In the lead up to that election.
Yeah, that's it. It was 2017, 2019 is when we had that correction. This time, I think it's worse because obviously we do have the tax changes. We've got RBA hiking aggressively and much higher. We're starting off from a worse point of affordability. So I'm talking nationally here. Certain markets like Perth's not as bad, obviously, But and Melbourne's actually not as bad from affordability. But nationally, we're starting from a much higher base, and then we've got all the we've got the unemployment situation starting to play out. The overall economic gloom, the sentiment's the lowest. The consumer sentiment, if you listen to the ANZ Roy Morgan, it's tracking at close to 50-year lows.
Lower than COVID.
Yeah. Oh, it's worse. Yeah, it's worse now. Which
is fascinating because we said this off air. We track a sentiment index through the podcast, actually. Like it's a newsletter you can sign up for. So quick little plug, sign up for the newsletter. We have over 2,000 people that complete that survey or the index. So it's a good sample size, right? Most are investors, so 65% at least got one investment property. But the confidence is actually strong and has increased. And in areas which is probably not a surprise to what you're saying there with the submarkets, areas like Queensland and Perth have actually increasing confidence post-budget. They're probably sitting on a pile of equity. They're seeing maybe an opportunity there, but we're actually seeing, and from a Melbourne perspective, it's neutral. I'll have the graph come up for those that are listening. Sydney's the only one that's confidence level has dropped slightly off the back of the budget. So it's interesting, because I've read that same article. We actually said it on a podcast recently about the 50-year low from a consumer confidence, but it'd be interesting to get your take on, from an investor standpoint, why are we actually seeing some positivity there?
First of all, you'd be dealing with a sort of, I don't want to say educated, because I don't make it sound like everyone else isn't educated, but like someone who's, what's the term I'm trying to use? Sophisticated is probably the better term. Sophisticated people who actually track the market. And I think in some ways, and this is going to sound counterintuitive, the run up to the budget in some ways could have been worse than the actual outcome, because uncertainty stops buyers, it stops sellers. When you don't know what's going to happen, you don't know what's coming up, it basically just puts a handbrake on the whole market, whether you're a buyer or a seller. Now that the budget's gone, at least we know what you're dealing with. So now they know what the rules of the game are. And that could have actually boosted sentiment in a weird way. So it's a bit like in the stock market when the market's falling in the fear of an event, then the event happens and markets boom straight after. Because even if the event happened as they thought, it's not worse. It could have been worse.
You must have listened to the podcast we recorded in this studio yesterday, because exactly what I said. I said the fear or the uncertainty of the event is worse than the event itself.
It is, 100%.
And you spoke to that in that APRA example, that in the previous election, in the lead-up, markets fell by the worst in 40 years, 8% in the lead-up to Bill Shorten's election.
Yep.
The fact that he didn't get in, they responded after that in such significant
Also, the Banking
upswing.
Royal Commission got handed down, and it wasn't nothing. It wasn't that bad, and it's like, so all that uncertainty was like lifted off, right?
Yep.
And we kind of got that now. Like although the changes aren't positive for prices, but at least if you're playing the game,
you know what it is.
You know the rules of the game are. Whereas before you were like, well, I'm not going to make a decision, and because I don't know what the rules of the game are going to be, and they could end up being worse than they ended up being, right? So I think just the fact that the rules of the game are now being laid out, that might have boosted sentiment, because everyone goes, okay, I know what I'm working with.
Yeah. And the only uncertainty that still remains in the market, which I'll be interested in your thoughts as the year plays out, is interest rates, because the fear of interest rates going up does more damage than actually rates going up, in my opinion.
Yeah.
And the fact when they throw out there could be 2 or 3, and that's the RBA's job, is to change consumer behaviour.
Yep.
If they come out tomorrow and said, or in 2 weeks when they meet and say, no more rate hikes for the rest of the year, market's going to respond really, really positive. And they're not going to do that. They're not going to say that. No. Even if in their mind they were going to keep it that way, they have to put in, they want to keep inflation down. So they're going to say...
Yeah, jawboning.
Yeah.
That's what they call it.
They'll pause it, in my opinion. I can't see them...
I agree with you, actually.
I can't see them increasing them in June.
No.
And on the basis of that pause, they'll come up with some commentary around that, expect more rate rises, because they don't want people to then go out and start spending, right?
Yeah, 100%. So it's about managing expectations.
Yeah.
And to your point, I think there's close to 0% chance we get a rate hike in June. I hope it doesn't come back to bite me. But for the simple reason, right? So you've got the RBA's got 2 key performance indicators. They're trying to maintain full employment, and they're trying to do price stability, right? Keep the inflation between 2 to 3%. The unemployment rate, the latest reading, 4.5%, was a lot worse than what the May Statement of Monetary Policy expected, which only came out like a week before the ABS did that. So they've already gone, okay, the labour market's worse. And then the latest inflation read was actually basically what they expected, but marginally better. Like, we're talking by a fraction of a decimal point, right? So inflation wasn't worse than they expected. Unemployment was a lot worse based on that. And in fact, in their minutes to the last meeting, the May meeting, which get released a couple of weeks afterwards, they actually suggested that they were going to wait and see how it all plays out and hold in June. So they're already looking to do that.
Yep. This reinforces that.
Yeah, 100%. So I mean...
How's the rest of the year play out? I've made a call yesterday.
I don't think there will be any more hikes.
Yeah, I agree. Okay.
Yep.
And which is against what the markets are predicting.
They've actually softened, though.
Yeah.
So the markets were only a couple of weeks ago, were tipping 2 more rate hikes.
Yep.
Now they're less than 100% chance of 1 more. So it's like a 90% chance they expect 1 more this year. I wouldn't be surprised if we don't get any more at all. But yeah, to your point, I think you're right. They're not going. The RBA's not going to come out and say, suggest that we're done. What they'll say something like, we want to see the impact of the rate hikes to date. We've got a moderately restrictive monetary policy. I want to see what happens over. Basically going to rely on the data.
Open.
Yeah,
yep.
Which is, to be fair, that's a smart move, right? That's what they should do. Like, they should always follow the data. But I don't think we will get another rate hike. Well, there's a good chance we won't. I don't really know, but no. Well, no. To be fair, I don't know. Like, none of us know, right? I can say I don't think this, whatever. But if I
agree.
Yeah, okay. Say Leith, you got to put $100 down on. We got to get another hike or not. I'd go, okay, I'm putting on no, but knowing that I could lose that, but there's a better chance I'd win. Double or nothing, right? So if I had to choose one, I'd put on the pile of no more rate hikes versus more, but I don't know. So anyone listening to me, I'm not an insider. I can't read the future.
But if that was to play out,
anything could happen.
If that plays out, there's no more rate hikes. That's going to have a positive impact on the market in terms of sentiment.
Yep.
It may reduce the price falling that we're seeing in some markets, right? Because they're driven by sentiment more than they're driven by anything else. So that could be the cushion that these markets need to stop them from continuing to bottom out, particularly Sydney and Brisbane, you've called it. Do you agree with that, or you think there's too many other
Well, I
factors?
mean, So I think we could get a pretty short and sharp downturn, and then next year, if the RBA starts cutting, and then who knows what the government's going to do with the rules. I mean, I think they'll keep them in for at least a year, but if they start sinking the polls,
they don't come into effect until July next one.
good point. Good point. Yeah, no. But if you're negatively gearing now, I know you can do it for a year.
Yep.
But anyone who purchases now is going to be expecting that they can't, right?
Yep, exactly. It changes their behaviour.
Yeah, 100%. And also, look, it's already changing the bank's behaviour and how they lend. But I wouldn't be surprised if again we end up following New Zealand at some point. It could take a couple of years, and they end up reversing just because we end up having a decent sized correction. People get annoyed about it. And then the negative gearing changes get blamed for it, even though they're not fully responsible, because I think we'd be
want someone to blame.
Yeah, that's it. So it's very easy to point the blame at that. Look, you crashed the market. And here's the other thing. So the government seems to... So obviously we're running a huge immigration program at the moment, like too high. Got a rental crisis, which to me is the bigger issue than the purchase affordability crisis.
Well, they're most vulnerable, right?
Yeah, 100%. And look, the rental data sucks. Like it's vacancy rates, if you go by totality, but SQM research is similar. They're back down to pretty much the lowest level in recorded history again. So they're going back to where the lows of a couple of years ago. Rents are now accelerating, so they're going up by, the latest reads, 5.9% over the year, which is almost double wage growth now.
So more than the $2 a week that they forecast?
Oh, yeah, mate, 100%. But look, it was already, that's irrespective of the tax changes. Like this is a migration versus supply story. But Treasury seems to think, and the government seems to think, that we're going to magically get this rebound in supply. I don't think it's going to come, because it is, if you look at the macro headwinds facing the construction sector, we've obviously had a roughly 40% increase in costs since the pandemic. So it costs way more to build. A whole bunch of builders are going bust. We've got much higher interest rates than we had at the end of last decade when we had that apartment boom. It was, like, the cash rate then was 1.5%, right, versus now. So we've got high interest rates. And then now, because of the Middle East oil shock, that's now driving up input prices again. So we're getting a second round cost inflation. And already a whole bunch of builders have come out. Active in Perth, Nigel Satterley, he came out. I think he's the second biggest house and land developer in Australia. He reckons because of the global fuel shock, it's added $50,000 to the cost of building a new house and land package. So $20,000 of that alone is the site preparation because of the cost rising diesel and that sort of thing. Your cement, your masonry, timber, all the inputs, the PVC pipes, everything's gone up in cost. So if you've got cost inflation there, on top of the cost inflation we've already had, we've got very strong labour shortages in the construction trades, partly because the government's doing the big build infrastructure. We've got all the renewable crap going up. That's sucking labour out of that area. So the macroeconomic headwinds for construction is massive. And here's the other thing nobody thinks about. There's actually a very strong correlation between construction rates and home prices. So when prices are falling, it makes it less profitable for developers to build. Because why would you put up an apartment block or a house that, say a house takes a year to build, apartment block takes, several years to build, and you think you can sell it at that, but the market's falling and it's going to cost you this to build? Why would you take the punt if you think there's a chance, because the prices are falling, you're only about to sell it for that and make a loss? So that's going to stifle construction as well. So CBA has been pretty good. They put out some forecasts where they actually downgraded their construction forecast for the next 3 or 4 years because of the Middle East shock. So they think the government's going to miss their housing target, the 1.2 million over 5 years, by 26%. So they reckon they're going to miss it by 315,000. And that's worse than what they were predicting before the Middle East. They reckon it's knocked out tens of thousands of homes. And so the government continues to funnel in huge numbers of migrants into the country when the supply side is getting even tighter. But they seem to think that they're going to magically get this uptick into rising prices and rising input prices, I should say, at the same time as we have falling established home prices. So that to me is just a recipe for worsening rental crisis. And that should, on a fundamental basis over the long term, should put some sort of floor under property values, you'd think.
Yeah, because the yield
Yeah, well, I mean, just the replacement cost, right,
Yep.
of housing. So,
Yep.
yeah. So if you're going to, increase the replacement cost of housing, well, it's going to at least put some sort of floor under the market.
Lachlan, probably one of the most enjoyable podcasts there. It went a lot longer than we actually thought. We didn't want to cut it out. So we're going to go part 2 with Leaf next week. So this has been part 1. Part 2, he gets more fired up.
Certainly does. He calls it how it is. It doesn't hold back. I like your property stance, your political stance. So you're right. Stay tuned for episode 2.
You've been listening to the Follio Property Podcast.